Welcome to This Explainer. Today, we're diving straight into a genuine Wall Street mystery, a situation that is literally splitting the investing community right down the middle. We're unpacking Lincoln National Corporation, ticker symbol LNC. Now, on paper, this looks like an absolute dream scenario for bargain hunters. But as we start peeling back the layers on the actual numbers, a massive valuation paradox emerges. And that brings us to the core question, the absolute paradox of our explainer today. How can a company look like the ultimate deep value bargain while simultaneously harboring massive, potentially devastating hidden risks? I mean, are we looking at a generational buying opportunity here, or is this just a classic value trap waiting to spring? All right, let's just jump right into this jaw-dropping metric. A price-to-earnings ratio of exactly 4 times. Just 4. For context, the broader market average right now sits somewhere between 20 and 25x. That means LNC is trading at roughly an 80% discount to the market. That single number alone is enough to make literally any value investor stop dead in their tracks. Section 1. The Valuation Paradox. A 120-year-old giant on sale. To really understand the gravity of these numbers, keep in mind we are talking about a Fortune 500 powerhouse here. Founded way back in 1905, they cover everything from life insurance to retirement plans. And right now, it's on a massive sale. When you compare the metrics, not only do we have that 4x PE, but the price-to-book ratio is just 0.85x. You are basically buying $1 of assets for 85 cents. And the earnings yield? It's sitting at an astronomical 26%, which completely dwarfs Benjamin Graham's 7% minimum requirement. Even while trading near its 52-week high, traditional metrics suggest this thing is suspiciously cheap. Section 2. Red Flags, Broken Financials. The Case Against LNC. Now, this is exactly where the mainstream narrative usually stops. But let's uncover the red flags those cheap multiples are completely ignoring. The absolute elephant in the room is right here, a catastrophic return on invested capital of just 0.2%. And if you zoom out to a 5-year average, it's actually even worse at 0.1%. When a company simply cannot generate a meaningful return on the capital it deploys, well, those cheap valuation metrics suddenly start looking a lot like warning sirens. Then, we have the wild roller coaster ride of their revenue. Just consider these swings. In 2022, they pulled in $18.9 billion. The very next year, revenue absolutely dropped off a cliff, plunging 38.2%. But then, in 2024, it rocketed back up over 53% to $18 billion. This is not the steady, predictable cash machine you want to see in an insurance giant. It's a highly volatile operation. So behind that seemingly cheap price tag, we actually have a catastrophic cash burn. We're talking negative free cash flow to the tune of $1.33 billion. When you combine that massive cash bleed with the revenue roller coaster we just talked about, the Benjamin Graham framework gives LNC a straight F grade, a 29 out of 100. Even Peter Lynch's famous PEG ratio completely breaks down here, swinging wildly from 1.59 to negative, simply because the growth is a total mystery. Continuing with the prosecution's case, practically every single one of Warren Buffett's quality metrics fails here too, highlighted by a gross margin durability of just 0.3%. Their earnings are entirely at the mercy of completely unpredictable external factors, things like market performance and mortality rates. Plus, management has almost zero skin in the game. Insider ownership is at a paltry 0.54%. Honestly, it's no wonder Wall Street analysts have an average target of $46.42, slapping a hold rating on it with less than 1% implied upside. Section 3. Green Flags, Deep Value, the Hidden Upside. But hey, we can't just look at one side of the coin, right? Let's bring in the defense and look at the highly compelling green flags that completely pivot this narrative. Guru Focus calculates a Graham number of $131.50 for Lincoln National. Compare that to its current trading price of roughly $46, and you are looking at a staggering 188% upside. If this historical model is even partially correct, they are practically giving this stock away. Let's see how they build this positive case. Alongside that 4x PE and an insanely cheap price-to-sales ratio of 0.45x, LNC actually boasts an elite 22.6% return on equity. Guru Focus also ranks them in the top 11% of insurance companies, giving them a 5 out of 10 narrow moat. Plus, they just posted their 8th consecutive quarter of growth, crushing it with a massive Q2 2026 earnings beat of $2.24 per share on $4.93 billion in revenue. And for the income investors out there, they pay a really safe 3.95% dividend yield with a payout ratio of just 21.8%. Crucially, management just executed a massive $5.8 billion reinsurance deal with Talcott Resolution to de-risk their legacy guaranteed universal life reserves. The market is definitely noticing this deep discount to its $48.25 book value, and analysts at Mizuho and KBW are actively raising their price targets into the low 50s.
Section 4. The moat debate. Does LNC have a competitive advantage?
Okay, we really need to settle this debate right now, because figuring out if Lincoln National actually has a moat is the absolute key to this entire thesis. Remember this golden rule from Warren Buffett: a return on invested capital consistently above 15% is the single best indicator that a company has a real, impenetrable moat. Yet, when we pull up LNC's actual ROIC, we get hit with this 0.2% figure all over again. That is literally 75 times lower than Buffett's required threshold. By this purely quantitative measure, the moat doesn't just look weak, it looks totally non-existent. And this brilliantly illustrates the incredible friction at the heart of this company. On the one hand, you have massive qualitative brand advantages, right? A 120-year history, high switching costs, and a massive advisor network. But on the other hand, you have a horrific quantitative reality showing negative free cash flow and terrible margins. It's a highly trusted brand, sure, but those legacy products are severely dragging down their actual financial returns. Section 5. Graham, Lynch, and Buffett, the ultimate expert face-off. It's time to put LNC through the ultimate value gauntlet. First up, Benjamin Graham. On the valuation side, LNC passes with flying colors, incredibly cheap multiples across the board. But Graham also requires 5-year earning stability, and LNC fails that miserably. The result is a pure paradox and a grade of 29 out of 100, simply because a defensive investor just cannot trust those violently swinging earnings. Next up, Peter Lynch. Now, his framework relies heavily on growth at a reasonable price. But for Lynch, the wild unpredictability of the insurance sector, combined with LNC's totally erratic revenue swings, means his framework completely breaks down. You just can't match a PE to a growth rate if that growth rate is a total mystery. His verdict is essentially not applicable, a forced pass. Finally, Warren Buffett. And man, this one is brutal, failing almost every single metric. A 0.2% ROIC, a gross margin of 0.3%, completely negative free cash flow, and a negative owner earnings yield. For Buffett, this is a hard fail. It is the exact opposite of the high-quality, cash-generating compounding machines that he typically looks to buy. Section 6. The final verdict: resolving the paradox. So where does this leave us with this ultimate cheap valuation, broken financial stock ahead of their November 4th earnings call? The absolutely crucial point before making any high-risk contrarian bet here is answering a few structural questions. Can Lincoln National actually stabilize its earnings? Will that $5.8 billion deal with Talcott be enough to fully de-risk their legacy book? And most importantly, can management turn free cash flow positive? Because if they can't, well, that 26% earnings yield might just be a total mirage. I'm going to leave you with this final, provocative thought to ponder. We've seen the incredible paper discounts, and we've seen the frightening structural cash burns. So is Lincoln National a massive deep value opportunity just waiting for a turnaround? Or is it the ultimate value trap? Do your own homework, read through those 10Ks, and let me know your verdict down in the comments. Stay sharp, and I'll catch you in the next explainer.